Hi everyone, thanks for watching this video. And this video is about fintech and differentiating between a fintech and a bank, and also how a fintech can take a journey towards a bank. And this is not a reference roadmap, but it's based on what has happened till now in the industry. So Uh, so technology has always been at the core of many industries, and it changes the way we do things. There is a cost of introducing technology and also running your operations on technology. Banks have been adopting technology to transform banking, and there have been few breakthrough technologies in the past that have totally changed the way we deal with money, such as credit card, ATM, and use of computers and electronic bookkeeping and so on. And if you notice that in the past, technology was very expensive, and that's why actually banks were probably one of the pioneer industries to experiment and adopt the technology. Banks have also been one of the biggest user of IT to develop the financial technologies that use economic and statistical models to create and value securities, money, estimate returns, make portfolio decision, calculate credit, uh, calculate risk, uh, and so on, eligibility checks. So financial technologies depend on information technologies to create key functions of the bank, so, including financing, deposits, and payments. And technological progresses affect directly the growth of the banks and also sometimes lead to industry consolidation through mergers and acquisitions. In the past, breakthrough technologies were first adopted by the large firms, I mean large banks, before small banks or small companies. And you can see an example like there are small banks running in the villages. In India, we call them Grameen Bank, and like a micro small financing companies. They are not much using technology. They just provide the banking services. That is, they can help people deposit money and they can provide micro loans to those people who are unbanked, to those people who don't have bank accounts. Whereas big banks own ATMs, they provide credit cards, and they use. Um, if you go to their branch, they have computers. They can provide tablets to their employees to walk around, and established banks have been the first to introduce online banking, mobile banking, and they when they are especially dealing with high net individuals, employees might be carrying tablets, moving around, sitting with the customer, and offering personalized services. Um, though technologies were available, they were they were actually used in a lot of back office operations, and they are accessible to both large and small companies. But the IT companies which provide the technology, they may charge relatively high fixed cost to small companies and offer significant volume discount to large companies, which puts small banks at disadvantage and slow to adopt these technologies. So, and whereas the IT companies, and this was the trend, and is still there, that IT companies provide the backbone of the big banks that the small banks can't afford. Whereas uh, what these technologies were, they were sustaining technologies. Those were the technologies on which an industry or an enterprise depend on. They are incremental in nature and they improve the product performance along the dimensions that customers and market values. So, for example, a bank who already has an online banking system and may have invested millions in this building this system will try to improve the customer experience year after year on this online banking platform. So this online banking platform is their main interface between the bank and the customer, and they might do customer surveys, they might look at the other banks online banking platforms and make those similar changes in their platform. uh, if you look at other industries, for example, racing car, so racing car is also kind of a technology that everyone can't afford, and the improvements in the racing car are like incremental improvements. We can't just suddenly start using some emerging technology and change the game. In similar are aeroplanes and back-end servers, large storage systems, and so on. Um, and it's also said that the companies who depend on these big technologies, or they also who have built a business on these big sustaining technologies, they generally are their their approach is from top to down. They attack from the top, so they are not looking at the smaller, very small things. However, at the same time, there are disruptive technologies, and these are the innovation that don't result in performance improvement, and also they don't result in improved customer experience or but they are cheaper and easier to adopt. They, they make it easier for a firm with limited funding to launch products in the market. So these disruptive technologies are in contrast to the sustaining technologies, and these disruptive technologies, many times companies don't need to own them, because they might be open source or they might be available as a service. So, for example, cloud computing was a game-changing technology because now any company, small or big, they can use. They have so available. The technology is available to both. They need to pay according to their usage, and they can use this. In similar, now most of the customers have smartphones, so company can build application apps and provide them to the smartphones. Or like most people are watching YouTube, and anyone can prepare the video and upload on YouTube. So adoption is very easy, using it very easy, reaching out to customers is very easy. And this all disruptive technologies have been in last 20 years, they have come. Similarly, you can look at the open source projects from Apache and cloud computing, which disrupted the technology market. Um, it's and It's made technology available to everyone, every organization at an affordable cost. And on the downside, disruptive technologies come with a risk that is worth taking for any small organization, but big companies generally are hesitant because large banks are designed to work with sustaining technologies that improve incrementally over an already established technology, such as a new version of data storage software with improved performance. An established bank will invest millions of dollars to improve the performance of their existing applications, even if they have become outdated, because their business depends on them. They can't actually migrate to a new technology. Disruptive technologies, however, on the other hand, lacks refinement. They might have performance problems and they might not have been proven, but and in many cases, but for a small organization, it's easy to experiment with disruptive technologies. And once the disruptive technology is available, and if someone has an idea, they can use disruptive technology, they can build a minimum viable product, and they can go to the market. And it has been observed that it is the disruptive technology that displaces the established technology, shifts the industry, and create products with an entirely new value proposition. For an established bank with a huge number of customers and legacy IT systems, it is very difficult to trust disruptive technology. But it's a lot easier for a young firm to experiment with disruptive technology, and this has led to the rise of fintechs. Um, I want to particular talk about this fintech M-Pesa because it was in early 2000s when there were not so many disruptive technologies like cloud computing, artificial intelligence, big data, cyber security. These were not there. But even before that, it was a fintech, and I believe it was the one of the initial successful fintechs which looked into the gap in the market. So what fintechs are doing, they look for gap, such as for example a customer segment where banks have not been able to penetrate, or a market segment where banks presence is not there, or a some kind of cost factor, or maybe like for example, and fintechs has multiple areas. I am particularly here focusing on payments. So in the past there was for payment there were credit cards. Still there are credit cards, but not everyone has credit card because there is a eligibility check. Not everyone is eligible to have a credit card. Second thing, there was a transaction cost associated with credit cards, and there was a high interest fee if you delay in paying the credit card bills. At the same time, opening a bank account was also not easy because there was a KYC. Not everyone had a KYC document. The accounts had a minimum balance requirement, and there were very few limited branches, and internet connectivity was not available everywhere. So there were many challenges. However, fintech company looked into the market, looked into those challenges, looked into the gap, that why there are unbanked population and how they provided them the facility that bank can't provide. So back in 2000s, mobile phone was the latest technological revolution, but most of the phones used, especially in developing nations, were feature phones. In a developing nation, there was also a emerging market, um, developing nation, and the one of the big problem was the money transfer velocity or speed because of the challenges such as poor internet connection at many places, feature phones, and the huge unbanked population. But what existed was banks uh, and telecom companies with mobile network, microfinance organizations. So microfinance organizations provide very small loans to micro enterprises and SMEs. M-Pesa was one of the initial major successful fintech solution in which a non-finance or non-banking organization found the gap in the process or chain, and they filled it with the help of technology. Traditional banks were unable to fill that gap. There was a huge unbanked population, and they needed a faster way to transfer money. M-Pesa project was a collaboration project among network operator, Vodafone, Microfinance Institute, and a traditional bank. So network operators bring connectivity. So they had an idea if we can transfer money on the mobile network instead of internet. And mobile network has a huge reach through the airtime reseller distribution network. So there was a local telecom company, Safaricom, who had merchant outlets in every part of the country. So they can use it. Um, and a microfinance organization has customers and they understand the market need from micro loans perspective and in other financial services also, but it is not a regulated bank. And a commercial bank were there as well, and but they were available mostly in urban areas or very few branches. But commercial banks have discipline, they have compliance aspects, and they follow security and privacy in terms of managing customer funds and data. And lastly, an important thing in terms of rise of fintechs is the government support, wherein they try to relax some of the regulations for fintechs, and they also facilitate collaboration between the fintechs and banks. And traditional bank tend to be a mature organization with well-established business practices, and they are cautious with change as complying with regulation and security is one of their prime concerns. So they ignored this customer segment, um, these micro merchants and unbanked customers who do very small daily transactions. So market need was a financial service of money transfer that can be used by customers with a basic model of mobile phone and in the absence of bank account. So a team in Vodafone with an entrepreneurial spirit with Safaricom created the idea of M-Pesa, a concept of e-money in which customers deal with virtual money on the behalf of real money. And Vodafone and Safaricom deal with real money with the bank. So customers transfer virtual money to each other, and Vodafone and Safaricom, in collaboration with bank, convert those virtual money into real money. So the bank they collaborated with was Commercial Bank of Africa to provide the conventional banking services, but these conventional banking services were put in the back end, and customer doesn't even know that okay there is a commercial bank in the sitting in the back end dealing with Vodafone, dealing with real money, when they whereas customers and small merchants are dealing with virtual money. And this model is a powerful model where fintechs sit in the front end and commercial banks sit in the back end. And so if a person A goes to an agent, so agent is a local dealer of SIM cards of Safaricom company, and a person can deposit money to the dealer, and dealer can update the e-money balance of the person A. So dealer mobile card dealer is actually an agent here who will deposit the cash received from the person to the bank, but the person just deals with the dealer. And person A doesn't have a bank account but has a feature phone. So person A uses the USSD menu. USSD is available on all phones, and we can build a menu inside it with options like option one you want to transfer money, option two check the balance. So person uses a USD menu on the phone to send money to person B, and USSD menu on the phone is driven by some backend server side application on the telecom operator side. So money transfer request is sent by the um, uh, request is sent by the person's feature phone to the backend server side application, which updates the e-money balance of the person B. And before updating, it might do some kind of validation check. So person B can further use the USSD menu to buy airtime from the telecom company or do more things depending on the options available. So if you're a fintech company, you can further see here there are still some gaps, and there are opportunities to optimize. But for example, users upgrade to smartphone, then that can bring a whole new world of opportunities in similar like in India, USSD was replaced by QR code. I mean, USSD is still there, but the majority of the transactions now done through QR code. And if a customer opens a bank account, then integrate the phone with the bank account, provide them with mobile wallet or mobile payment app, real-time settlements, faster money transfer. Once the customer is onboarded on the platform, FinTech can offer other financial services such as related to lending and insurance. So fintechs are working in many areas: mobile payment and wallets, money management, cryptocurrency, and investment management. So in the case of money management, fintechs, they don't themselves open bank account. Instead, they try to pull the transactions done by customer in their existing bank accounts, and then they try to consolidate that data, uh, create a kind of multiple categories, like where customer is spending money: restaurants, bars, hotels, shopping, and then they try to provide insights to the customer, how they can actually save money, along with they can offer some other products, and those products which fintechs can offer can itself be part provided by the partners. Fintechs themselves don't need to actually build those products. Embedded finance is another area, but it's a next level of fintech company where a non-financial company integrates financial services into its products. The ultimate goal for this cooperation is to offer customers more convenience. As the old saying is that it's easier for customer to spend money. If it's easier for customer to spend money, they will spend more money. And non actually, that's why all the non-finance companies are now interested in financial industry, because they myself not actually provide financial services, but they can pull the financial services provided from other financial companies uh, by going into a partnership with them, and then integrate those financial services into their existing customers' journeys and experiences, and their existing products. For example, most of the retail companies have integrated payments. So it's on their online shopping is one example, and there are many ways actually: transportation industry, property, healthcare, everywhere actually payments, lending, investments, and insurance you can see getting integrated. For example, Amazon launched. Yeah, I have an example here. Amazon teams up with Barclays to enable customers to pay in installments in UK. So Amazon goes into a partnership with Barclays and starts providing credit cards. So these are like co-branded credit cards where Amazon UK customers can apply for the credit account from Barclays, which lets them spread the cost of eligible purchase on Amazon in equal monthly installments. Similarly, Paytm has been providing Paytm Wallet to customers for years, and then they started providing other financial services from partners like credit card and lending, insurance. Also, there is another company, PhonePe, that has gone into full insurance industry, but they can also provide this in partnership. So once you have customers, once like actually, if a fintech provides a payment app and they have huge number of customers, then the insights from the payment and the consumer services enables fintech company to offer various financial services products. Lending, for example, is a key product in this segment, and the revenue model for fintech is the sourcing fee, so which is typically some percentage of the loan value. So when customer purchases the loan product from the fintech platform, the fintech company gets some uh, fee from the company which is actually providing the loan product. And then they also charge some transaction value when the loan is dispersed, and also when the customer repays the loan using the payment platform. Then they can expand their offerings to include e-commerce, advertising, and co-branded credit cards. Neobanks are like like a similar to bank. They take full advantage of open banking and banking as a service. They provide deposit and they provide credit card. So banks, a bank is primary function of a bank is to provide deposit accounts where customer can deposit money and get interest. Now this is the difference between a fintech payment wallet and a bank deposit, that in fintech payment wallets they don't give any interest, whereas a bank give interest. And why bank can give interest? Because bank can also lend money. They provide credit cards to the customers for a spend, and they can charge interest on that, and transaction fee also. So if a fintech company starts providing these two services, not not like a co-branded, but with its own brand. So like Apple Card and Apple Savings Account. So technically, Apple doesn't have a banking license. It is a front end, but and in the back end is the Goldman Sachs. But in fintech area, we can call it a neobank, where the Apple doesn't even yet have a banking license, but the customers of Apple doesn't even know that who is actually providing the banking services, and they use Apple Card, they use Apple Saving Account as if Apple is the bank. This is a journey where fintechs who act as an agent sitting between the customer and their bank account provide payment app and money aggregation and other services with improved customer experience, and they comply with KYC. So they they champion the financial inclusion and offer low barrier to entry investment, insurance, and credit products to the previously unbanked customer. Next, they move into embedded finance. Now, actually, it can be fintech who upgrade to embedded finance, or it can be a non-financial company, a big company like a telecom, retail, healthcare, which can move into embedded finance. They do it by placing the financial products from their partner financial companies into their existing non-financial customer experiences, journeys, and platform. And established relationship plus the growth of cloud and open APIs set the stage for these non-finance companies to collaborate with banks on one or more financial products. And typical products are payments, buy now, pay later, deposits, lending, insurance, and different type of cards like gift card, employee card, and co-branded credit card. Now, companies at this stage tap the value that lies beyond payments and transactions. They are value-added services. Um, Now, next level is a neobank. So still, it's a non-financial company. Uh, we can say now it's a non-banking financial company. So it's a financial company but doesn't have a banking license. That they operate exclusively online, do not hold a banking license, but they come under the category of non-banking financial companies. They might offer, but still they offer banking platforms with basic services such as current account, primarily to small and medium-sized businesses, and enhanced by features such as payroll, expense management, and automated accounting. And they do it in partnership with a full-service bank. Most of the now these neobanks have fintech roots. In general, Apple was a neo. We can say Apple is a neobank, but it doesn't have a fintech root. Okay, it has a different where I said that a non-actually finance company with all the resources enters into financial services, taking the route of embedded finance. Whereas many neobanks have fintech roots, and they still serving a particular segment of customers. Next level is challenger bank or digital only bank. They hold banking license, but they don't have a physical branch, or rarely they might have a branch. They grow vertically within few customer segments instead of expanding reach horizontally to all customer segments. They also have a fintech roots in general, but it can also be that there is a traditional bank who was previously had a physical branches and everything done through branches moves into digital banking space where they close their gradually their physical branches and they digitalize all their services, so and they move from physical to a digital bank. Whereas the last segment is a full service bank, which is licensed, regulated, and FIDC insured bank with 10 to 20 plus years of experience offering full suite of financial product to most customer segments. Note in India, virtual banking license are still not granted, though there are foreign national banks offering digital only products through Indian subsidiaries. The RBI remains stern in prioritizing banks' physical presence and lately reinforced the requirements for digital banking service provider to have some physical presence. Thank you very much. I hope you like it. If you like, then please subscribe to my channel. Thank you.